Understanding production efficiency, a comprehensive overview. Production efficiency is a critical concept in economics that determines how effectively an economy or an entity utilizes its resources to produce goods. This efficiency becomes particularly crucial as companies and economies scale their operations, impacting profitability and competitiveness in the market. Key takeaways. Definition: production efficiency refers to the point where an entity can no longer produce more of one good without reducing the production of another, occurring along a production possibility frontier, PPF. Measurement tools: efficiency can be quantified using the formula \\text efficiency equals \left \frac \text output rate \text standard output rate \right times 100 interconnectedness with other metrics, capacity utilization, cost return efficiency, and economies of scale are all integral to understanding operational efficiency. What is production efficiency? In depth, production efficiency describes the level at which resources, such as labor, materials, and capital, are used in the most optimal manner to yield the maximum possible output. This means every resource is being fully utilized to produce the most cost-effective product. When all resources have been allocated effectively, adding a unit of production will require sacrificing another good, highlighting the trade-offs present in resource allocation. Production Possibility Frontier, PPF. The Production Possibility Frontier is a graphical representation used to illustrate production efficiency. The PPF shows the maximum feasible production levels of two goods, illustrating trade-offs. The curve indicates all combinations of outputs generated under maximum efficiency. Here's a simple conceptualization. Graphical representation: the x-axis might represent the quantity of good A, e.g., guns, and the y-axis might show good B, e.g., butter. Points along the curve indicate efficient production levels, while points inside the curve represent underutilization of resources. Example of PPF. Imagine a manufacturing company faced with the decision to produce either guns or butter. Max outputs: it can produce 100 guns, 100 units of butter, or combinations thereof, e.g., 80 guns and 60 units of butter. Trade-offs: producing more butter means reducing gun production. This trade-off exemplifies the opportunity cost, highlighting production decisions' implications on overall efficiency. Importance of measuring efficiency. Production efficiency isn't just a qualitative measure, it can be tracked quantitatively. The formula used to assess efficiency allows organizations to analyze different sectors or employee outputs systematically. A production efficiency of 100% means the output rate equals the standard output rate, showcasing optimal performance. Productivity versus efficiency. While often used interchangeably, productivity and efficiency represent different aspects of performance. Productivity measures output relative to input, like how many units a factory produces per labor hour. Efficiency, however, focuses on maximizing output while minimizing waste. A factory might be productive but not efficient if it produces excess waste. The interplay between the two is crucial. Companies need both high productivity and efficiency to thrive. Economies of scale. Economies of scale refer to reduced costs per unit as production scales up. This creates a close relationship with production efficiency. Advantages of scale: larger operations can purchase materials at a discount, spread fixed costs over more units, and leverage specialized machinery. However, companies must be wary of reaching a point where diseconomies of scale emerge. As an operation becomes too complex, inefficiencies can arise, increasing per-unit costs. The role of market competition. Market competition serves as a catalyst for enhancing production efficiency. Companies must strive to innovate. Competitive pressure spurs investment in new technologies and processes. Optimize resource use. Firms assess their production processes rigorously to minimize waste and reduce costs. Case studies of competitive efficiency. 1. Tesla. By optimizing its assembly line, Tesla managed to have its production costs for electric vehicles, showcasing how competition drives innovation. 2. Starbucks. The company's move toward reusable cups not only reduces waste but also lowers costs, consolidating efficiency with sustainability. Measuring production efficiency. Production efficiency can be measured using various key performance indicators, KPIs. Overall equipment effectiveness, OEE. Labor productivity. Cycle time. Defect rates. Capacity utilization. These indicators, combined with analytical tools like PPF graphs, provide a comprehensive view of an organization's efficiency performance. Lean manufacturing and efficiency. Lean manufacturing principles emphasize waste elimination and process optimization. Techniques such as just-in-time, JIT, production. Continuous improvement, Kaizen. Value stream mapping. Help organizations streamline operations, focusing on activities that generate value for customers while minimizing non-value-added tasks. Impact of supply chain management on production efficiency. Effective supply chain management contributes significantly to production efficiency by ensuring the timely availability of inputs, reducing lead times, optimizing inventory levels. When materials are readily available, firms can operate more efficiently, preventing production lags and maintaining a steady output. Conclusion. Production efficiency is vital for economic growth and competitiveness. It epitomizes maximizing production output while minimizing resource input, making it essential for companies striving for profitability and market relevance. By employing various measurement techniques and embracing principles like lean manufacturing, organizations can enhance their efficiency, leading to sustainable growth in today's competitive landscape.